Hello everyone, welcome to Global Online. Today we are going to see NTA UGC NET Paper 2 Commerce 2022 batch, and this one is the fifth lecture of Unit 2, that is Accounting and Auditing Unit. In today's lecture we are going to see ratio analysis, and this is one of the most important topic because the practical question which you are going to see in the exam will be based on the formulas. Okay, so in this lecture we are going to see the different formulas which are the important from the exam point of view. Before we start with the lecture, I want to tell you that we the Global Online providing the course for the paper 1, in which we are providing you the daily life lecture, notes on all the topic, last 10-year question papers with a detailed explanation, test series covering 2500 MCQ with the detailed explanation. To get this, download our app Global Online or WhatsApp on this number. Okay, and the fees for this is 3500 rupees only. Students, we are also providing course for the UGC NET Commerce Paper 2, for which you have to download our app, that is Global Online, from your Play Store. Once you download the app, you have to register your number and go in the store and search for the UGC NET Commerce Paper 2. In this course, you are getting the complete video lectures on all the unit, notes on all the unit, test series, plus the previous year question papers with a detailed explanation and target based preparation. And if you are taking this course, the paper 1 you will get the free of cost. No need to buy the paper 1 separately. Okay, and the cost of this course is 7000 rupees only. So let's begin with the today's lecture. So what is ratio analysis? That we have to understand here first. The relationship between the two accounting figure is known as the ratio. The ratio analysis is a process of comparison of a one figure with the another, which help to make a proper analysis about the strength and the weakness of the firm operation. So here ratio means what? What we are looking for? Here we are comparing one figure with the another figure, and this figure help the business, help the organization to make a proper analysis about the strength and the weakness of their operations. Okay, basically it is a relationship of the accounting figures, the numbers. Okay, the calculation of the ratio are a relatively easy and a simple task, but the proper analysis and the interpretation of the ratio is an important task. We can easily find out the ratio, okay, because it is a easy and a simple task, but we have to do the proper analysis and a proper interpretation, and that is the important task here. The ratio analysis is an important, powerful analytical tool useful for measuring the performance of the organization. It is extremely helpful in providing valuable insight on the company's financial picture. Again, the ratio analysis is important here. It is an important analytical tool for measuring the performance of the organization, the value of the organization. Okay. Then is the classification of the ratio. When we see the classification of the ratio, that time we are talking about a liquidity ratio, leverage ratio, activity ratio, and a profitability ratio. Here the liquidity ratio is they measure the firm ability to meet the current obligation. Second is a leverage ratio. This ratio shows the proper proportion of the debt and the equity. How much debt is there and how much equity is there in the financing the firm's asset. Then is activity ratio. They reflect the firm efficiency and utilization the asset. And last one is the profitability ratio. This ratio measures overall performance and the effectiveness of the firm. How the organization is performing and how much it is effective, that we are looking in the profitability ratio. Current ratio. The ideal current ratio is taken as 2:1. Please remember this. Okay, you have to remember this figure 2:1. This ratio measures the short-term solvency of the company. What this current ratio is doing? Current ratio is measuring the short-term solvency of any company or the organization. Current asset are the asset which can be converted into the cash within the 1 year, and the current liability are the liability that are payable within the 1 year. So what is important here is when we are talking about a current ratio, here the current asset will be converted within the 1 year. Same applies to the current liability. The liability should be payable within the 1 year. Okay. The formula for the current ratio is current ratio equal to current asset divided by current liability. Please by heart this formula. The another important formula here is liquid ratio or the quick ratio or the acid test ratio. The ideal liquid ratio is taken as 1:1. Please remember this. The liquid asset will include the cash in hand, cash at bank, sundry debtors, excluding a bad debt and readily marketable security. So what does liquid asset is including, that you have to remember, because to find out a liquid asset you have to use this. Okay, you have to add all these things and you have to minus the bad debt and the readily marketable security. The prepaid expenses and the stock are not taken into the liquid asset. The whatever prepaid expenses are there of the organization and the stock, the inventories will be not included in the liquid asset. Here the liquid ratio equal to liquid asset divided by the current liability. Sometime they will ask you to find out the liquid asset, and to find out a liquid asset you have to remember what is included in the liquid asset. Okay. Debt equity ratio. The debt equity ratio is used to ascertain the soundness of the long-term financial policy of the business. The main purpose of the ratio is to determine the relative stake of outsider and shareholders. Now, why this debt equity ratio is used? Is used to ascertain the soundness of the long-term financial policies of the organization. And the purpose of this debt equity ratio is to determine the relative stake of the outsider and a shareholder. Shareholder is a person who has taken the company shares. The debt equity ratio equal to long-term debt divided by equity or total liability divided by shareholder funds. We use this formula to find out the debt equity ratio. Then is capital gearing ratio. It is an important ratio. Gearing should be kept in such a way that a company is able to maintain a steady rate of the dividend. Dividend is what? Dividend is the interest which is given to the shareholders. High gearing ratio is not good for a new company or a company for which the future earnings are uncertain. Okay. So now how we are getting this capital gearing ratio? For this there is a formula, that is fixed income or a dividend bearing fund divided by equity shareholders fund. Now to find out the fixed income bearing fund, there is again formula for which we have to take a debenture plus long term loans plus the preference shares capital, we will get the fixed income bearing fund. And to find out the equity shareholder funds, we have to take a equity shares capital plus reserves and surplus minus debit balance of profit and loss account minus fictitious assets. Proprietary ratio. It expresses the relationship between the net worth and the total asset. What exactly this ratio is doing? This ratio is expressing the relationship Between what? Between the net worth and the total asset, which we have to remember here. The high proprietary ratio is indicative of strong financial position of the business. Higher the proprietary ratio, stronger will be the position of the business. Okay, and the higher ratio is a better for the organization, better for the firm. So here the proprietary ratio equal to proprietary fund divided by the total asset is the formula to find out the proprietary ratio. Proprietary fund equal to equity share capital plus preference shares capital plus reserves, and we have to minus the fictitious assets. And total asset is a fixed asset plus the current asset. Excluding the fictitious asset means we don't have to add the fictitious assets here. Then is interest coverage ratio. The interest coverage ratio show how many times the interest charge are covered by the fund and are available for the payment of the interest. A very high ratio indicates that a firm is conservative in using the debt, and very low ratio indicate the excessive use of the debt. This is called the interest coverage ratio. And to find out the interest coverage ratio, you have to know the formula. For this, the formula is earning before interest and taxes, that is EBIT divided by interest expenses. You will get the interest coverage ratio. Then is the debt service coverage ratio, that is DSCR. Don't get confused if you receive this DSCR. So DSCR means the debt service coverage ratio is a ratio which is often looked into by a bank when they evaluate the credit proposal. Each bank has a benchmark DSCR below which they get the little requirement to grant a loan to the company. Okay. So this ratio is used by the bank and not the company, and the formula for this is net operating income divided by total debt services. Total debt services cover both the interest and installments. Then there is a gross profit ratio. The ratio measures the gross profit margin on the total net sale made by the company, and it is calculated based on the formula, that is gross profit divided by sales multiplied by 100. You will get the gross profit ratio. Okay. Then is a net profit ratio. This ratio measures the efficiency of the operation of the company. So why we are using this ratio? We are using this ratio to measure the efficiency of the operation of the company. The net profit is arrived at from the gross profit after deducting the administration, selling and the distribution expenses. The ratio is calculated like net profit ratio equal to net after tax, that is PAT divided by sales multiplied by 100. Then is a return on the investment. When we say return on the investment, means the amount which we are getting after investing some amount in some project. Okay. This ratio shows how much company is earning on its investment, that is the capital employed. Whenever the company is investing in some project, the company in return will get some amount as a investment amount, that is return on the investment. This ratio reflects the overall efficiency with which the capital is used. The return on the investment is an important measure of the profitability and is useful for inter-firm comparison. The return on the investment can be calculated by operating profit divided by capital employed multiplied by 100. Then there is a return on the investment. The profitability of the firm is a measure by establishing the relationship of a net profit with the total asset of the organization. Now here we are looking at the relationship between the net profit of the company with the total asset of the company or the organization. And this ratio indicates the efficiency of the utilization of an asset in generating the revenue. Revenue means the income for the business. So here the return on the investment equal to profit after tax divided by net asset of the company multiplied by 100. You will get the return on the assets. Then is earning per share, that is EPS. This ratio is calculated to judge the overall profitability of the organization. So the EPS, that is a earning per share, is calculated to judge the overall profitability. How much the profit the organization is getting. Okay. The ratio measures the profit available for the earning per share. The ratio measures the profit available for the equity shareholder on per share basis. Okay. So here this ratio is available, or this ratio measures the how much the dividend, how much the interest available for the equity shareholder. Okay. Now here the equity shareholder are the person who has buy the shares from the company. The equity shares of the company, they are called the equity shareholder. Okay. The equity shareholder on a per share basis is calculated from this ratio. Now here the earning per shares equal to profit available for equity shareholder divided by the number of shares. Then is price earning ratio. So here this ratio measures the number of time the earning of the last year at which the share price of the company is quoted. Price earning ratio is the barometer of the market sentiment. The higher the price earning ratio reflect the higher earning potential, and low profit earning ratio reflect the lower earning potential. Okay. So basically this ratio is measuring the number of time the earning from the last year, okay, the past year, at which the share price of the company is quoted. Here we are looking at the share price which is quoted by the company during the previous year, during the past year. Okay. The higher the price earning ratio will reflect the higher earning potential, but the low price earning ratio reflect the lower earning potential. Here the price earning ratio equal to market price divided by EPS, that is earning per share. Then is a stock turnover ratio. This ratio measures how many times a company inventory has been sold during the year. If the inventory turnover ratio is low, it means either the inventory is growing or the sales are dropping. Okay. Here we are measuring how many times the company has since the inventory is being sold during that particular year. The stock has been sold during the particular year. And if the inventory turnover ratio is low, if this ratio is low, that means either that inventory is growing or the sale is dropping. The sale is going down. The stock turnover ratio equal to cost of goods sold divided by average stock. Now how we find out the average stock? To find out the average stock, there is again the formula. The average stock equal to opening stock plus the closing stock divided by 2. Then is working capital turnover ratio. This ratio indicates the extent of a working capital turnover in achieving the sales of the firm. To find out a working capital turnover ratio, we have a formula, that is sales minus working capital. We will get the working capital turnover ratio. Then is the debt ratio. The debt ratio refers to the ratio of a long-term debt to the total of external and internal fund, that is capital employed or a net asset. It is computed as the debt ratio equal to long-term debt or a capital employed.